All right, this is part 2, and we are doing the year-end adjusting journal entries. We did in the last one normal entries, and then we posted those to the ledger, and it tallied up the unadjusted balances for us. So now we're going to do the year-end adjusting entries, okay? So it tells us to accrue rent revenue, see terms above. So that happened here. It was $150,000 for 12 months on August 1st. So we have to count how many months are left in 2001. August, September, October, November, December. That's 5 months, and we have to multiply times the rent per month. And what we're going to do is recognize. So we're going to recognize, and I'm going to do the accounts first. I think it's a great idea to separate out the accounts and the amounts, because sometimes people get confused about accounts, other times it's about amounts. So we're going to increase rent revenue by accruing it, and we're going to decrease the liability account, unearned rent revenue. It's a little confusing because it has revenue in its title, but we haven't earned it yet, so it's actually a liability. So we owed them a place to live, the tenants a place to live for 12 months. And at this point, we get to recognize 5 months of it because 5 months have passed. So 5 months, and the amount of monthly rent is the $150,000 for the year divided by 12. So we can put the formula right in the cell there. Okay, and even better yet, what we could do is, in case we say, oh, we made a mistake and it's 130,000. Okay, that's 62,500. Debits equal credits. Bam, there we go. Income tax for the year was 6,000. So if you go to the chart of accounts, you'll find income tax expense. And remember, I'm indenting the credits 2 spaces. Income tax debits before credits, always in journal entries. Nothing to calculate here. Our tax accountant gave us the number. Taxes are complicated. So that's why we have not 1, 2, 3, but 5, 6 classes of taxes. So we got that number from some tax accountant. Adjust insurance expense. So let's see, 8,000 for 10 months, and we have 5 months again, but let's start with the accounts. You increase expenses with debits, and we're going to reduce. So up here with income tax, we recognize the expense, increase the liability. Here we have insurance expense, which is still a debit, but we had the asset prepaid insurance. So it's a credit, but we're reducing an asset. Okay, and again, it equals 5 months. And they told us the monthly amount was $8,000. And again, I could go up here and point to the 8,000. And then it's divided by, it was not for 12 months, that was for 10 months. So we used up 4,000, half of the amount of our prepaid insurance asset. So if we cancel the insurance today, we get 4,000 back. Okay, looking good. Let's see, what do we have here? Mortgage rate is 6%, and the mortgage is interest only. Interest is paid on January 1 and July 1 of each year. So we're going to have interest expense, indent, interest payable. So we're going to accrue the liability today, and actually tomorrow, January 1, we're going to pay it off. And again, it's 5 months of interest times, let's see, what is it? 800,000 times 0.06, which is the annual rate. All right. Divide all of that divided by 12. So the D8 times 0.06 is the amount of interest we pay a year divided by 12. This is all the amount we pay for a month, or accrue a month, and it's 5 months. Okay. So 20,000 in interest. All right. And here we have, building has a 30-year useful life and a residual value of $50,000. Management uses straight line depreciation. So we have depreciation expense, which represents kind of the using up of the service life of the business, of the building, excuse me. And it doesn't go to the asset account, it goes to accumulated depreciation, which is a contra asset. Okay, still it's classified with the assets, but has a normal credit balance. Now, the depreciation is 5 months, and we're going to figure out how much depreciation per year, right? So residual value of 50,000. So the building is 900,000, and it's minus 50,000. Okay, so we're going to depreciate over 30 years. We're going to depreciate 850 of the 90,000, and then we can sell whatever's in there for scrap or whatever. So this is the total depreciable base or basis in the numerator, and it's depreciating over 30 years with 12 months per year. So this whole thing I just highlighted, that would be the monthly depreciation. And let's see, we got 11,806. Okay, kind of a funky number, but I guess that's what it is. 850, 50,000. Looks good. And equals this. Okay, so that's all the adjusting journal entries. Now, we're going to not post them to the ledger right away. In the next part, what we're going to do is we're going to start filling out the trial balance and put these adjustments here. So the next part 3 is doing the trial balance. So I'll see you in video 3.